Hey traders, we just wrapped up day 2 of our 2020 Ascension workshop, and I want to share with you a highlight video showing you what we discussed. Now, it was a very powerful session. If you were there live, you know exactly what I mean. If you weren't there live, don't worry, the full recordings are now up on the site. They should have hit your inbox already if you have registered. If you have not registered, make sure you head over to www.tier1trading.com, register for that Ascension workshop. That way we can shoot you the full recordings each and every day, as well as a link to join us live if you want. Tomorrow is going to be a great session. We're going to talk about trading psychology. We're going to do more live trading and analysis, talk about rules-based trading, and talk about how to treat your trading like a business. So trust me, you don't want to miss it. All right, I hope you guys enjoyed the highlights, and I'll see you tomorrow. I think it's crystal clear that we understand that when the market is moving like this, right, a violation of this level tells us what? A violation of our lows tells us what? A violation of this tells us bearish continuation. So now the next question is, well, Akil, what is a violation? So this is where we're going to add on to the concept that we taught you yesterday. In order for a violation, write this down. In order for a violation, we need to have a lower low, lower close. So we need a break below, close below. So that means the candle that violates that level not only needs to break below the previous lows, but it needs to close below. This is why it's important to understand how to read a candlestick. The close is very important. There is a massive difference between just having a break below and a hold versus a break below and a close. They are two completely different signals that will could potentially put you in two completely different trades. It doesn't matter if it's on you need a break below, close below on whatever time frame you're doing analysis on. So whatever chart you're currently marking up, that is what you need a break below, close below on. Now the concept of reading a price chart, candlestick formation, reading a trend, it's the same on every single time frame. Eventually, you'll get into the point where you do multiple time frame analysis. So you'll be looking at multiple time frames, and different signals on different time frames will give you different predictions about lower time frames. But for right now, we're sticking to the very basics. We're going to focus on just learning how to read a price chart, because if you can't read a price chart on one time frame, you cannot read a price chart on two time frames.
So you really want that above 1. Because you're right at 1, then you've got those things to consider plus mistakes. You're probably going to be a just under losing trader, right? Just under break even. So you really want a little bit more than this, right? So what if reward is 3? Well, that's much better, isn't it? We're 35% accurate. Now that hurts my ego. It hurts. It's painful. But what the data tells you is the truth, not your emotions, not what you feel. Now, will this be hard to execute for some? Yeah. Some traders are not going to be able to do it, and that's okay. You might just have to trade something else or do a better job with the win rate. Maybe try to at least bring it up to a coin flip, which is no better than 50%. And then you could have lower risk reward scenarios like 1 to 2 and be successful. The point of this entire exercise, now the expectancy is huge here. It's 4. That's probably, I don't know if that's that, that would be amazing. Now these are hard things to come by sometimes. So it's a balancing act, like I said. And the point of this exercise is to show you that it's not all win rate, and there's risk reward as well when it comes to how many pips we risk, and again, leveraged market, how many we stand to get in our reward. Okay? And if you can't handle the low win rate, that's fine. That is something that you can change through improving the quality of your entry, or also changing yourself, right? Changing your own perception of what trading is supposed to be. Trading is supposed to be profitable, correct? That's what we want. So if the win rate is not tied to me being profitable, that's what I wanted to show you, because so many traders, so many people push this out in the market because newbies and people that want to be right because they think they have to be right to be successful want a high win rate. So people throw out the big numbers in win rate. I'm here to show you that it doesn't matter. It's not the be all end all. They work together. It's win rate and risk reward. It's all working together. Now, when we talk about position size and money management and how much you risk in terms of a position, that is a completely different thing, especially when you talk about leveraged instruments, which is why I wanted to say keep this in pips, okay? I risk 1 to make 3. I risk, that's however many pips it is for you. Maybe you have an average stop loss because you use a moving stop loss because it's dynamic, or it's a fixed stop loss and it's always 30 pips. Whatever, it doesn't matter. There's a ratio involved. And then what you do with your position size is an entire another topic, not for today. That would be money management, okay?
And imagine this being a slate of ice, this pink line, purple line, right? And price action is a fish underneath the ice, underneath the frozen lake. What does that ice stop the fish from doing? Breaking through, right? It is resistance on the top of that fish. Now let's say there's a little crack in the ice and the fish manages to break through. And let's assume that it doesn't fall back in the same hole that it broke through from. Now that fish is on top of the ice. Somehow it's grown legs. And it's walking this way. What does that same level of resistance now become to the fish? It has legs and it can breathe. It's a new fish. It's evolved. Worst analogy ever. That level of ice now becomes support. It's one of those Simpson three-eyed fishes. There we go. It now becomes a level of support. So once structure is broken, it's not irrelevant. It's actually very relevant because price tends to come back to that level. This is why we call these things decision points, right? At one point, it was a decision. It was a battle between the bulls and the bears. Once that battle was broken, if the battle were to return to that same place, there's typically another battle because it had importance before. And a big part of trading is being able to understand what levels in the market have had previous importance, because there's a good chance that they will be important again. And if you ever take some time to look at charts, you will see this over and over again.
Lay it out. Does everyone want to see this? Just the overall process, that what your path to success actually looks like. This is the same path that we take all of our traders down, okay? The same thing that I've been doing with traders since I got into the education part of it 5 years ago, okay? Nothing different. All right, tons of yeses, good. Didn't think there'd be any no's, but you never know. So we start out. Now we have a chance where we can stay at failure, which is kind of like spinning our wheels. I'm gonna call failure just stuck, right? We haven't achieved success yet, which is what? Profitable trader. Now over time, we're gonna do some stuff and we're gonna hopefully move towards success rather than stay stuck or experience more failure and disappointment. So what are we gonna do? We're gonna learn profitable skills like you are here today. You guys are learning about how you need to conduct yourself, what the path is that you need to follow, what you need to have inside of your trading plan. I've dropped tons of stuff in what needs to go into that. We talked a little bit about backtesting and win rates and risk reward and psychology and all these different things. And what do you do with that stuff? Well, you train and practice. What does that take? Time. Okay, it takes time. But you get through it, and then you might have some more questions. You need some mentorship on some stuff. You're not quite sure about X, Y, Z, or what have you. And so you practice those things. Maybe you fix some mental aspects of yourself that you're struggling with in your trading. And what do you do then? Well, maybe it's time to create and test that trade plan. Well, whew, that takes some time. We're going to have a dip in our equity curve, of our success curve, if you will. Maybe we'll create a money management schedule after we finish the testing. We've developed our trade plan. We've tested it. We've got a portfolio now. We know what time frames we're trading. We know what all the numbers are. We create a money management or position sizing schedule on that, what we predict we're going to do. That's always an estimate. We never know exactly how that will play out. And then what are we ready for? Then we are ready for trading. Okay? Then we are ready for trading. Notice, this is moving up. That's no mistake. This curve is moving up towards success while the 90% curve was moving down. There's a reason for that, because that's what you're going to experience if you do one way versus this way. If you do the 90% way, you pretty much ensured failure or no success. And if you do it this way, I cannot guarantee your success, but by golly, this is the only way that I have ever seen work for anyone.